Monday, March 9th, 2026 made financial history. WTI crude spiked to $119 a barrel, its highest level in nearly 4 years. Then it violently crashed back down by over 30% in the same session. So what just happened, and what does it mean for every major asset you are trading? The oil shock and surge were structural. The Strait of Hormuz, which handles roughly 20 million barrels of daily global supply, is effectively blocked. Southern Iraq output is reportedly down 70%, with several producers declaring force majeure. The market was pricing in a genuine shortage of physical oil delivery. But the violent crash triggered the moment President Trump came out saying the war would end very soon.
I think soon.
Okay, and with respect
Very
to...
soon. Look,
Dismissing it as merely a quarrel to resolve, the market snapped back instantly. An estimated $6 trillion was lost in value from US markets in that single session. The G7 is signaling emergency SPR releases, and OPEC Plus has announced a modest production increase for April. But with the Strait of Hormuz likely to remain blocked as long as the conflict continues, these are pressure relief valves, not solutions. The next headline from the Gulf will probably move this market violently again. But let's zoom out. Like, Trump wants a weaker dollar to manage a mountain of national debt. But the geopolitical shock forced a massive safe haven bid into the dollar. And the Fed, if oil prices remain high, that is an inflation shock. And summer Fed rate cuts evaporate. But if oil prices keep falling, the Fed's path reopens and a June cut might start getting priced in. Right now, rate cut expectations are around where they were before the war started. So everything hinges on what happens next. In the Gulf, Europe remains the most vulnerable. Energy dependent, facing a surging dollar, and with no domestic oil buffer, the EUR-USD pair is displaying that weakness directly. But China faces the deepest structural problem. Before Iran even escalated, the US extracted Venezuela's Maduro, cutting off 389,000 barrels per day. Add Iran's 1.38 million barrels per day, and roughly 15% of China's total oil imports are gone overnight. Russia is now their last major discounted supplier. But here is the real macro story. China sits on hundreds of billions of US dollars in reserves. Being forced to buy oil on the open market in dollars drains that capital. So what does China do? They have already been answering that question. 15 consecutive months of PBOC gold purchases, quietly reducing US Treasury exposure while building a hard asset alternative. The dollar strengthens in the short term. But every barrel China is forced to buy in dollars might accelerate its long-term push away from it.